Alright, so welcome back to my 10th weekly forecasting video where I go through all of the major financial Forex markets just to sort of give some insight and bias and weekly direction for the up and coming week, and covering some of the stuff that's happened in the previous week just to give you some insight into why things have happened and my bias going into the week. So jumping into this, we mentioned last week that we're on the DXY. We've been trading lower and lower all throughout the year. We pointed this out last week, where ever since pretty much the second week in January, we've traded all the way down. And we pointed out the fact that within a Forex market, we always want to find some sort of equilibrium, because we can't just sort of go one way forever, because the dollar needs to be competitive in export trade. So it's unreasonable to just expect moves to just keep going, unlike stocks, as already mentioned. So we've seen a big trade-off, and we were sort of expecting some sort of relief on this to go higher. So if I just put my drawings on the screen, this is nothing new. You can go back and watch the marking out of the charts. We will drop down to a daily time frame, and it's really starting to shape up quite nicely actually as a market maker buy model. I mean, we've been going step by step with this throughout the weekly commentaries. We ran sell side liquidity, displacement up, failure swings, and sort of just fair value gaps as entries. Then we marked out this original consolidation. This was a market structure shift right here. We've come down, tapped every single fair value gap, everything marked out perfectly. Has been hit, really, to be honest. We had this volume imbalance marked out last week, and we said we'd target this as a draw-in price, because although this might be a longer term draw, we always take it one step at a time. Each leg in price is a new way to get into the market. So in hindsight, one of the things that I want to point out is this has been perfect delivery from technicals. We said a couple of weeks ago, with the sort of uncertainty around the Federal Reserve, that we wanted to ensure that we were leaning on the technicals a little bit more, just to give us some direction, ADR direction within the markets, and that has been the perfect decision. And a lot of things, I think, with this is whenever you're looking at trading yourself, sometimes you have to look objectively and trust whatever you are going to look at, because a big problem that I had when I started out was you'd know the pattern, you'd know the play that was maybe at hand, but you can't see it as it's printing in real time. And a lot of the work that I've done is to make sure that when it is printing in real time, I can spot these movements in price and trade them myself. So that is exactly what we have seen here. We've marked it out, which is a really good case study. If you guys haven't been able to jump onto this and make sure that you've been using this market maker buy model in order to engage in the market, at least get some screenshots, annotate your own chart, spend some time, don't just screenshot my chart, and make sure it's within your playbook as, right, this is what I'm looking for. It's a fractal thing. It'll happen on a 15-minute time frame if you are an intraday trader. It will happen on the 4-hour daily, the weekly if you're a swing trader, and it just keeps going. So this is your bread and butter, really. Within this, these fair value gaps, if you drop down to a half an hour time frame, let's say, maybe, we can see the exact same thing here. We see just displacements away from these weekly arrays, and then OTEs higher. We see this all the time. It's market maker buy models from these arrays as well. So it's sort of beautiful, really, the fractal element of the market. So we did see, jumping more into a fundamentals case study, we saw that the Federal Reserve had actually cut basis points by 25 basis point cut this week on the Wednesday from the FOMC meeting, which means the rates are actually reduced, which reduces the saving power of the dollar, which means investors will likely look to sell their positions. However, from that information alone, you would expect the dollar to trade lower. But we've seen a huge reaction higher. And why was this? Well, actually, it's because we mentioned last week that it's likely already priced in. And what I mean by that is when something is already priced in, investors have already had the information they need to make a decision on what is going to happen moving forward. So although the official cut was on Wednesday, investors already pretty much knew this before and already did their trading to sort of counteract for this. So the question I mentioned last week, it's always about what do the smart money think and how have they already positioned within that. And within this, we already had the relief all the way down here. This was when they were talking about the cuts and then the displacement reactions higher. And then the question wasn't actually, are we going to have a cut or not? It was, is it going to be a 25 basis point cut or a 50 basis point cut? And we actually had the 25, which is less severe than the 50. So if we had a 50 basis point cut, I presume this would have traded lower due to the shock element in the market. We've always got to think about market pricing when position ourselves within these moves. So once that 25 basis point cut was confirmed, we had the reaction higher, as investors were likely right and they'd already priced in the correct, what was sort of expected within institutions. And we did actually capitalise on this. So if I just move over to the euro, we always use the DXY as a measuring stick, but trading different pairs that are correlated or inversely correlated with the dollar. We had this perfect move here. It's ran on buy side liquidity, legs down, and it's nothing new. Like, that's the thing. If you've been watching these videos week on week, I hope it's been useful and provided some insight, because it's been a perfect couple of weeks for case studies. If you haven't seen the previous weeks, I'd definitely recommend going and watching the last 4 or 5 just to sort of learn these things and maybe give yourself some sort of case studies for having direction within the market, because it's been perfect. The market's been perfect to a T from a technical analysis point of view. And we've been capitalising swings on this. We've marked this out. It's been there. We said we wanted optimal trade entry from this level, and we got it, and it's delivered to these relative equal lows. It's just textbook stuff. It's nothing new. Every time I approach a trade, I don't want to be looking for some smart new entry. I don't want to get in too early. I don't want to get in lower in the range and mess up my risk to reward. I'm always looking to capitalise on the same thing, which is that run on stops, displacement lower, and then OTE legs from down here. So it's literally just optimal trade entries from this range. And if that doesn't look convincing enough, we go from here to here, and we just wait for that extra failure swing just as an extra confluence. So there's something definitely you can learn from this. And I'm sort of happy with the fact that I've been able to implement this playing out every single failure leg. There's nothing new, there's nothing special. And that's exactly what's been delivered. So actually talking about GBPUSD, there's been big talks about a cut, which this is one thing we did point out last week. At the time of when entering this trade, this one right here, the Euro GBP was sort of just sideways price action. And I mentioned the fact that whenever it's sideways, you want to choose the most highly correlated, inversely correlated to the DXY, which was actually the EURUSD. So we chose that. But the GBPUSD, due to the news about people thinking there's going to be another cut, has actually shown real signs of weakness, which was good if you had managed to capitalise on this move. We had a lot of downwards price action, a lot of volatility in the market with this, but the euro has delivered pretty nicely as well. This inverse fair value gap here, we tap this, come back down, straight run to sell side liquidity over here, failure swing on this high, same sort of thing. If you were in from here, again, nothing special, it's the same thing, different markets. And it's just delivered really well, really. I think when euro and GBP USD are moving well, I don't really tend to look at other pairs like USD JPY, USD CAD, these sorts of things. I don't really tend to look at. I just sort of mark things out, potential areas, and just always keep an eye for what's going on within the markets, but we didn't need to this time. So the thing that the Federal Reserve have come out for, sort of adding a bit more perspective onto what's up and coming, the lack of jobs data has been an even more sort of, it's left more incentive to not leave a roadmap for the Federal Reserve. Usually they would come back and say, we have this plan and this is what we're aiming to do. But with the lack of data, they've sort of held off on giving any sort of direction on what they're going to do, and they're going to take it FOMC meeting at a time. They don't want to lay out like the next 3 FOMC meetings. We're looking to lower interest rates, which would actually help direction, which again just tips its hand back into that idea of you've got to have an understanding of the fundamentals, but then the technicals is what you're going to rely on to see the market, and you need those two to align for low resistance liquidity runs. But we've sort of had both within these commentaries. I remember the let's go down USD CHF trade that I presume it's still marked out because I've not even traded this pair. That was heavily fundamental based. You know, we knew that the job market was getting worse. We knew that inflation was rising, but we saw the data just keep getting worse and worse, which allowed this run to sell side liquidity to happen, which is why we capitalized on this move. So a very, very fundamental trade, sitting through all of this chop because we knew it was coming. But to contrast that, the EURUSD was lent a lot more on technical analysis. So you've got to have both plays in order to accurately depict what you're sort of engaging with in the market, because I didn't have anything for USD CHF this week. You know, there was nothing for me to sort of want to interest me. I chose the euro because it made more sense for the reasons I've explained, which trade breakdown video will be coming soon for this. Again, I've got more trade rate breakdown videos within this channel, so you can go and watch them to see the different reasons of why I take different things. Again, we've had the market already priced in this 25 basis point cut from the Federal Reserve, so we don't sort of expect any shock within the market. And the last thing to mention would be that the quantitative tightening has been signalled to be ending, which means quantitative tightening is brung in to curb inflation, which has obviously been a problem within the US economy. It just stabilises the price of goods and services. However, there has been signs of that actually ending now. We had CPI come out the last week, or the week before, sorry, I covered it in last week's commentary. And we said that although it was actually reduced from forecast was 3.1, but 3% come out. That is still elevated above the Federal Reserve's 2% target, which means inflation still needs to be sort of managed. But quantitative tightening can't happen forever, so that's been a sign in the market. Now, to pull up the Forex Factory calendar, just for you day traders out there and swing traders, anyone, to have a look at the up and coming week, the 2nd of November. We've just had daylight savings time, so the markets don't usually react within this period, but things should be moving back to normal now. So on the Monday, we have ISM manufacturing PMI. Again, it's a relatively easy driver. I wouldn't potentially look to trade the Monday. The JOLTS job openings. Again, we've said before within the commentaries, job openings, any job data that we can actually get a hand on that isn't subject to the government shutdown will be very key in the market, very sensitive. So keep an eye out for anything unemployment claims related, JOLTS related. That sort of stuff will likely bring reaction in the market because we've had such a lack of data, and then this new data will sort of pave the way moving forward. The Wednesday is ADP non-farm employment change. Again, similar thing. We've got these unemployment things that we need to keep an eye out on, and then the big news drivers are actually at the back end of the week. We've got unemployment claims. If we can get that will be likely a volatile move within the market. And back end of the week, we have the non-farm payroll. So first Friday of every month. Again, all subject to the government shutdown. But if we do get the data, I'd rather give some sort of roadmap for you guys on how to approach the week. With how volatile NFP can be, and especially because we've not had many in the past, many data points to go off of. If you are day trading, Wednesday would be when I'd cut ties with the week. I'd say Thursday, Friday, I'd let this direction pan out, because then you can go into the week after with a bit more perspective on the market of how you're going to trade that. Sometimes you have to give up those sort of huge data reports, especially when there's been a lack of it, to give you an age or direction within the markets. So thank you to yourself for watching today's weekly forecasting video. There's a lot of stuff in this video that I've spoken about and covered previously, so If you want to see this happen week on week, I definitely recommend keeping up with all the videos, making sure you're going over the trade breakdown videos to see what different elements go in. If you want to improve your own trading, then I'd say it's highly probable that you're going to find some sort of insight and usefulness out of these. So thank you very much for watching, and have a safe week's trading.